Hi there. Organizations, giants or small, they have three sources for their cash. Cash comes from the retained earning, which is the accumulation of the income or the profit, which is resulted from the daily buying and selling of the commodities or the services. Between the brackets, we call it the operation. So cash comes from the operation. Secondly, cash also comes from borrowing money, either from the bank or from the debt holders by issuing, debts, or by issuing shares or stock to the shareholders. That is, we call it the equity. So from the debt and the equity, that is between the brackets, we call it the financing activities of the business. And or the third source is from buying other companies' shares, or it's selling its fixed asset, or we call them the plant asset or plant and equipment asset. That is between the brackets, we call it the investment operation. So let me repeat that then. I say that so cash comes from three sources: from operation, from financing, and from investment activities. Usually giant organization mix all these together. I mean, we cannot as organization depend only on operation, or we depend only on financing, or we depend on investment only. But bear in your mind is the accurate and the most healthy activity is from the operation, which shows that the company is working and it's generate its cash from its operation, from its from its effort and from its talent and from its good management and officers or managers. As he said, among the three is the best. What is the operation or cash flow from operation? So the higher the cash flow from operation, the better the organization. Where the companies which depend on investment by selling its fixed asset, for example, we say it is a risky operation, or a risky organization. And that is the more investment and the less operation. That's cash flow from operation or cash flow from investment. So that is the worse the companies. Also, the companies or the corporation or giant organization which depend on finance, which means the rate of finance is exceeding the rate of operation and the rate of, financing. Again, it is risky. Yes, I know that business needs cash, but it should generate its cash from its effort. I give you actual example, and that is not only theoretical saying. If I am a lender and you come to me as the owner of the organization, or if you are the managers of the organization or the executive officer of the organization, or a group of manager, you come to me as a lender and you show me your cash flow. Definitely I will make my analysis. Yes, I will look at your balance sheet, I'll look at income statement, but I will focus on the statement of cash flow. And when I analyze your cash flow, my eyes should go to the cash flow from operation. I want you to generate your cash from your own. So the more, as I said, cash come from the organization, that means you are healthy organization, and there is, little chance of getting cash flow problem. But the opposite is true. If I look at your cash flow statement and it shows in fact a huge amount of financing from outside or investment by selling your asset, I say, that will give me at a glance you are at risk. That will give me the bell which ring. That will give me a red flag, and I say, this company now or maybe in the future it will generate cash flow problem. So therefore cash flow from operation is the best source of activity. And goodbye.